How an India plus global portfolio helps your financial plan. In the more recent past, with a plethora of platforms now available for you to be able to invest internationally, this is a question that comes to us very often. That should I go ahead and buy international ETFs, international mutual funds, international bonds, international stocks, etc. India has clearly been a very, very powerful global story, both in terms of its economy as well as how financial markets have been doing. But we need to keep in mind that when you go back and look at data, you will find that different geographies do well at different points in time. For example, in the year 2020, Korea delivered a 45% return, driven by electronics and automotive sectors. In 2021, the US did really well, up 28% on the back of tech, as well as what happened as a recovery post-COVID. In 2022, when global markets were weak, you found that the ASEAN actually fell only by about 4%, outperforming everyone else. And in 2023, Taiwan, on the back of semiconductor stocks, did really well and was up about 31%. So all in all, there seems to be data which seems to support having portfolios that are a blend. So what are the advantages of having international investments as a part of your portfolio? Number one, the fact that there is a correlation between markets which could actually be controlled through the use of international investments. For example, you would find that if you had constructed a pure China portfolio, vis-a-vis a portfolio that was a blend of India plus the US plus China, this blended portfolio would have done much better than a pure China portfolio because of all the challenges that China has faced. The second benefit is a currency hedge. You can see that the Indian rupee tends to weaken against the US dollar traditionally. And while that rate of depreciation has been falling over a period of time, the rupee does tend to depreciate nevertheless. And therefore, if you have a US portfolio and a US dollar portfolio, you could actually benefit from the currency depreciation that happens on the rupee. This is also very useful because some of your expenses itself may be in foreign currency. For example, the travel that you do overseas, or maybe education for your children. These are all areas where a currency hedge could be very useful. Number three is valuations and valuation comfort. What you might find at different points in time is different geographies are quoting at valuations which are more attractive or less attractive. And therefore, if Indian valuations today are expensive, you might find other geographies elsewhere in the world where valuations are more reasonable. And that allows you to construct a portfolio which has a blend of more expensive, probably India valuations on the back of the growth that it potentially has, combined with certain other geographies which may have more reasonable valuations. Number four is the fact that you might want to take exposure to both developed and developing markets. Developing markets tend to offer you higher growth, but they also come with higher volatility and more risk. In contrast, developed markets could actually end up being more stable and less volatile as compared to emerging markets. And therefore, what you try to do in a portfolio is combine both of these together. Last but not the least, there are certain sectors that are well represented or better represented in certain geographies. And that's what you're able to get access to when you get to using global portfolios. For example, you might find that some of the large tech names that we all get access to are listed in the US. Or you might find that automobiles are better covered through Germany. Or you might find that semiconductors are very well covered in Taiwan. So all in all, we think that investors, now that they have access to be able to build international portfolios, need to take advantage of it. It's clearly time for investors to look at an India plus fund strategy when they're building their investment portfolio as well.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of Basel and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client, and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory. This material is for information and educational purposes only.